So you're hoping to get a loan for a new house or a new car, and it is a very exciting time for you, and you know that your credit score is a major factor in getting your loan application approved with favorable terms. And you're probably trying to make sure that your credit is in really great shape before you do that. But since you clicked on this video, you may not know exactly what to do, but don't worry, I've got your back. Because today we're going to go through and look at the #1 way to raise your score potentially by up to 50 points. If you're curious, stick around. Welcome back to the channel. I'm Andy from Credit Sage, your best source for all credit and finance related data. With over 3,000 reviews and a 4.9 out of 5 Trustpilot rating, you can trust that we have the knowledge and expertise to guide you. And today, I'm excited to share some vital information that, trust me, you don't want to miss. So let's begin. To understand how credit scores work exactly and how you can improve yours, first, you need to know what a credit score is. So we'll start right there. What is a credit score? It's simple, really. A credit score is a 3-digit number that represents your credit worthiness, or how likely you are to pay back a loan on time. It's basically a number that tells lenders how trustworthy you are when it comes to borrowing money. Lenders use the score to grade your ability to repay the loan promptly. So it's like proof that you'll be reliable. Now, credit scores usually range from 300 to 850, and the higher the score, the better you look to lenders as a borrower. Now, here's an example. Let's say you want to apply for a car loan. The lender will check your credit score to see how much of a risk you are as a borrower. If you have a high credit score, say above 750, the lender will see you as a low-risk borrower and may offer you a lower interest rate. But if you have a lower credit score, say below 600, the lender may see you as a higher-risk borrower and may either deny your loan application altogether or offer you a loan at a higher interest rate to offset their risk. Now, this scenario is a start to explain why you should want to improve your score. Your credit score will play a pretty big part in most of your financial decisions. Now, here are some other examples of how your credit score can impact your finances. Let's look at insurance premiums and deposits. You see, insurance companies may use credit scores as a factor in determining the premiums you pay for auto, homeowner, or renter's insurance, and landlords may also use credit scores to determine whether to rent to you at all and to set the security deposit amount. Just like lenders want low-risk borrowers, well, landlords, of course, want responsible tenants. Also, job applications. Did you know that some employers may check your credit report as part of the job application process, particularly if the position involves handling money or sensitive financial information? Now, while your credit score may not be the only factor in a hiring decision, a poor credit score could raise concerns about your trustworthiness and financial responsibility. So now let's talk about what goes into calculating your score. Your payment history is the most critical factor that affects your credit score. It accounts for about 35% of your score and reflects whether you've made your payments on time in the past. Late payments, delinquencies, and defaults can lower your credit score and stay on your credit report for up to 7 years. Credit utilization is the amount of credit you currently are using compared to your total credit limit. It accounts for about 30% of your credit score. And ideally, you should aim to use no more than 30% of your available credit at any given time. High credit utilization can indicate financial stress and lead to a lower credit score. Also, the length of your credit history accounts for about 15% of your credit score. It considers how long you've had credit accounts and how often you use them. Generally, a longer credit history with a good payment record can improve your credit score. Also, the types of credit you use account for about 10% of your credit score. Having a mix of credit types such as installment loans and credit cards can demonstrate your ability to manage different types of credit responsibly. When you apply for new credit, lenders may check your credit report, which can result in a new credit inquiry. This accounts for about 10% of your credit score, And multiple credit inquiries within a short period of time can indicate that you're taking on too much debt and may lower your credit score. Now, let's move on to the fun part, improving your score. As you've seen, a healthy score is a combination of many different factors, and you have to work on each one of these things to improve your score. There's no best way, per se, to raise your credit score, but there is one great option, and that is to hand the job over to CreditSage. You know, even if you are doing all the proper things to maintain good credit, one negative item or multiple negative items like inaccuracies and delinquencies can really be a drag on your credit score. And at CreditSage, we have experts on call who know exactly what to look for and how to deal with errors in your credit history. Instead of dealing with a pile of papers and that you're not sure what to do with and how to deal with all of that, why not just leave it to the professionals? You know, a successful dispute can potentially raise your score by up to 50 points. So don't waste any time. Save yourself a ton of stress. The number is in the description below, so give us a call. Now, on the other hand, if you really want to handle this yourself, here are a few things you can start doing today. First off, keeping your credit card balances low is one of the most effective ways to improve your credit score. Ideally, you should, again, aim to use no more than 30% of your available credit at any given time. Focusing on paying off high balances on your credit can have a positive impact on your credit utilization ratio, which, as I mentioned, is almost a third of your credit score. Also, simply paying your bills on time. Late payments, delinquencies, and defaults can drastically lower your credit score and stay on your report for up to 7 years. And it's rather avoidable. So just be sure to pay your bills on time, even the minimum amount. And if you have trouble remembering, consider setting up automatic payments or an alarm on your calendar to remind you. Your payment history is the most critical factor that affects your credit score, so stay on top of it. Also, one that not a lot of people think about is errors on your credit report can negatively impact your credit score. So you want to review your credit reports regularly and dispute any inaccuracies with the credit reporting agencies. And you can do this by requesting a free credit report annually from each of the 3 major credit bureaus. Collection accounts can stay on your credit report for up to 7 years, damaging your score the whole time. And if you have outstanding collection accounts, work to pay them off or negotiate a payment plan. Once you've paid off the collection accounts, request that the creditor report it as a paid in full to the credit bureaus. Another little trick is requesting a higher credit limit. This can help lower your credit utilization ratio, as long as you don't increase your spending also. This can improve your credit score and demonstrate to lenders that you're a responsible borrower. Now, some credit reporting agencies allow you to report rent and utility payments to your credit report, which can help establish your credit history and improve your credit score. So check with your landlord or utility company to see if that's something that they offer. Also, you want to try to keep a mix of different credit types, such as installment loans and credit cards, which can demonstrate your ability to manage different types of loans and credit responsibly. You know, consider adding a new type of credit to the mix, such as a personal loan or auto loan, but again, only if you can afford the payments and interest that will be attached to that. And it's important to really take the long-term approach when implementing these steps to improve your credit score. By doing so, you can gradually build a strong credit history that will serve you well in the long run. Remember that managing your credit is an ongoing process that requires discipline and consistency. But I want to remind you, if you find managing your credit overwhelming, and believe me, it can be very, very stressful, you can always turn to CreditSage for help. With just a quick and easy phone consultation, you can sign up with our services and have the task of managing your credit taken off of your shoulders. You see, our team of experts can provide personalized guidance and support to help you achieve your individual financial goals. If you found this video helpful, please show your support by hitting the like and subscribe button to our channel for new videos each and every week. Thanks for watching.